Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Monday, July 27th, 2020. I am pre-recording this Trading Places Live for Tuesday, July 28th. Futures are currently a little bit higher, doing a little better on the NASDAQ than on the major indices, other major indices, I should say. But that was the case on Monday as well. We saw the NASDAQ outperform. We're going to get into all that in just a minute. Our agenda for today, we'll get into that daily market recap to start the day, and then we'll get into talking technically. I want to go through and look a little bit at sector strength on an absolute basis, talk a little bit about materials, gold, silver, a lot of strength in that area of the market as the dollar continues its decline. Then we'll get into turning point, show you some charts, some of the things I look for in terms of short-term trading. These are stocks that could be at some key turning points in terms of maybe hitting support and bouncing, or maybe failing at key resistance. Earnings spotlight, got a few more companies out tonight. Things are really going to pick up later this week. Just to give you a quick rundown on Tuesday Tuesday during the day, both pre-market and after the market closes, we've got Visa, Amgen, McDonald's, Starbucks, AMD, Advanced Micro Devices, Dexcom, a big medical supplier, company that's been doing extremely well, eBay, then we've got DR Horton. Go to Wednesday, we got Facebook, PayPal, Shopify, Boeing, ServiceNow, Lam Research, Spotify, Teladoc. Thursday's the biggie: Apple, Amazon, Google, Eli Lilly, AstraZeneca, United Parcel, Gilead, some other big biotechs. We got Vertex Pharmaceutical, Seattle Genetics, two big ones there. Xilinx, I'm looking for potentially a good report out of Xilinx on Thursday. We'll see whether or not that develops. Electronic Arts, Atlassian, which is ticker symbol TEAM, Expedia, MGM. List goes on and on. A lot of big reports coming up later this week, and that is certainly going to have a major impact on which way we go in the market. We're going to find out rather quickly this week whether or not the market's already built in all the good news, or if these companies can take the market even higher after they report their results. And then we'll wrap up today with the three you must see. Before I get into any of that, I just want to point you to earningsbeats.com. Please subscribe. We have a free Earnings Beats Digest newsletter. It comes out Mondays, Wednesdays, and Fridays. We talk about a lot of individual stocks. We give potential trade candidates, look a lot at relative strength, earnings, technical patterns. Sometimes we just look at industry groups. There's a lot there that I think you can take a look at and hopefully learn from some of the things that we do at Earnings Beats. If you want to join our service for 30 days, it's a great time. We do have a fully refundable $7 30-day trial. So normally it's $97 a month, but our trial period is only $7. We'll even refund that $7 to you. So you can have a no-cost trial for 30 days and check everything out. You can see there our portfolios and how they've performed. This is through today's action on Monday. So you can see model portfolio now. It's been a little over 20 months that we've been doing this with the model portfolio. The group, this particular portfolio since inception, up 114%. The S&P over the same period up 20%. So clearly we're doing some things right. A lot of it has to do with always keeping leaders in our portfolios. So you've always got your money working hard for you. But feel free to check that out. We'd love to have you in our community. All right, let's get into the action from Monday. Dow Jones Industrial Average up 114 points, the S&P up 24. NASDAQ on a relative basis, you can see they're leading the action up 173. This was the only index, by the way, that started the day beneath its 20-day moving average, but by the end of today, it had rectified that. You can see NASDAQ now 10,536, well above the 20-day moving average, which is at 10,401. I guess we'll find out on Tuesday whether or not we can hold that. Mid caps also up nearly 1%, small caps up a little more than 1%. All of our moving averages, though, are now exceeded by all of our major indices. So we are above the 20 and the 50-day moving average across the board there, which is very bullish. As far as individual sectors go, Monday we had really strong action in technology. Materials, as I mentioned, just been on fire with the dollar completely falling apart. That weakness in the dollar, by the way, continued again on Monday. Actually, it seems to be accelerating to the downside. So it certainly appears like it wants to break below key trendline support on the dollar, which over the longer term bodes very well for materials, no doubt about it. So if the dollar continues to move lower, this is something we want to watch because we have broken out on materials. They look really strong. They now, by the way, have the highest scooter rank among all of our sectors. So materials have moved into the #1 spot there. Real estate also pretty nicely, more than 1%. You can see though, look at the difference between technology, which has been going up, materials breaking out, and then real estate, which topped back on June 8th and has actually just been kind of drifting lower, maybe in a little bit of a triangle pattern. Then you've got healthcare, which is broken out. Healthcare up nearly about 0.75%. Communication services bouncing off their 20-day moving average, also up just a tad. Let's keep moving on. 10-year Treasury yield. By the way, as far as economic reports go, on Tuesday morning, we're expecting the May Case-Shiller home price index to come in at about increase 0.5%. April's rise was 0.3%, so we're looking for a little bit of an increase there from April. Keep in mind a lot of these home construction type reports are typically delayed a couple months, so we're looking in the rearview mirror back in May. I expect it to be good numbers, but unless we have some kind of a real miss, I would suspect the market's for the most part going to ignore this. I think the market's already anticipating that things have been picking up in housing. July consumer confidence also will be out tomorrow. The expectation there, 95.7. The June number was 98.1, so actually looking for a little bit of a pullback there. The FOMC meeting begins. The next one begins tomorrow and culminates with a Wednesday 2 p.m. Eastern policy statement. So we will find out the latest from the Fed. I gotta believe they're going to remain very, very accommodative. No change in rates. I wouldn't expect anything there, but I do expect them to say that they are still willing to do whatever it takes. And market typically likes the accommodation, and I think we'll see. I'm at least looking for a positive reaction to the Fed meeting. All right, later this week, we will be getting Q2 GDP numbers. They'll be coming out. The initial estimate is for contraction, 35.0%, versus Q1, which was a contraction of 5%. So definitely numbers will not be good, but the market's already anticipating that. Market isn't worried about what happened last quarter, I can promise you. The market always worries about what's coming the next 3, 6, 9 months. So don't worry about the report last quarter. The market priced that in when we took the big tumble back in February and March. What we're now doing is we're in an uptrend because the market's anticipating better economic news down the road. All right, let's keep moving on into talking technically. And in talking technically, I want to go through these sectors and give you an idea of what I'm looking at here. The good news is when you're in a secular bull market, which I have said all along, I believe we've stayed in one, but we not only came up and cleared certain moving averages, but we've been trending above it. You can see the XLK, which did move below the 20-day moving average, although we did finish well off the lows on Friday. We came back on Monday and right back up above the 20-day. Now, I think probably what's going to happen is we're going to see sideways consolidation. We do have more big tech reports coming out later this week. Like I said, Facebook, Apple, Amazon, things like that. That could drive the XLK. Well, Amazon, not so much, nor Facebook, but Apple is part of the XLK. Apple certainly could be a big driver in sending the XLK higher later this week. So we'll want to see how that report comes out. But the other key areas, you've got consumer discretionary, which I can pull up. That is certainly going to be impacted by Amazon and their report coming up later in the week. But again, could we sideways consolidate? If we don't get a breakout with Amazon's report, then yes, I think there's a good chance that this is another area that could consolidate, but still in an uptrend. The XLC in an uptrend, breaking out, just recently took out the February high. I think this group continues to look pretty good. Some might look at this and say, wasn't there a negative divergence, higher price, lower PPO? Yes, but not the way I look at the market. I look at the market when we tried to break out here back in late June. Notice that that failure came with the PPO falling. We went back and hit the 50-day moving average, got very close to the center line. In my opinion, that's what I refer to as a reset. And then as we move back up again, you can see the PPO beginning to rise. So I actually look for the 20-day to hold when the PPO is back on the rise again. So I'm not surprised we rallied today. I would expect the XLC to continue to rally. This is going to once again come down to Facebook. As long as Facebook doesn't fall apart, I would expect the XLC to continue to trend above its 20-day moving average. The XLF, financials. Financials and industrials are the two groups, the two aggressive sectors that just have not performed well. And financials are not going to perform well if the 10-year Treasury yield continues to stay low. Financials, especially banks, life insurance companies, investment services, asset managers, all of these companies tend to do better when the economy is improving and rates are going up to anticipate that improving economy. 10-year Treasury yield did rise on Monday, which was good, but you can see financials pulled back, hit the 20-day, and did bounce off of it. We did not finish higher in financials on Monday, which is a little bit of surprise with the 10-year Treasury yield bouncing a bit. But financials have moved up over the past couple of weeks, and the 10-year Treasury yield has not. So a little bit of a disconnect there recently, but if this group is to really turn higher and make a run for the June high, I think we've got to see yields moving up. Maybe that happens after the Fed meeting, we'll see. Could be that there are a lot of folks buying treasuries heading in to the Fed meeting, and they may exit either just before or just after the Fed meeting. And of course, if you exit treasuries, that sends yields higher. So I wouldn't be surprised to see the yields pop a little bit after the Fed meets. We'll see. Next up, XLI, another sector that it looks fine. I mean, it's still in an uptrend, just like the financials are in an uptrend, but just a laggard. XLI and XLF have not taken out the June 8th high. All the other groups that I looked at earlier have. They've all gone up and taken out that June high, no problem whatsoever. Many of those other groups, actually all the other groups, took out the February high. So not only the June high, but the February high. So you can just see the relative weakness here in industrials and financials has not gone away. And I don't think it's going to anytime soon. We might short-term have, a little bit of outperformance, but that long-term relative weakness in both the XLI and the XLF, I think is probably going to continue for a while. How about XLV? Move into some of the more defensive areas, although some parts of healthcare are aggressive. Certainly biotechs can be very aggressive, medical equipment. But then you've got other areas like the pharmas, which tend to be much more defensive, maybe even healthcare providers as well. But the group is broken out, cleared these prior tops, trending above the 20-day. PPO coming off a centerline test looks strong. This is another group I think that looks very, very good. XLP, we've had relative weakness in this group, but from an absolute basis, this group looks fine. Double top, we broke out, haven't reached the February high, but we're getting close. PPO looks strong. We're trading above the 20, which is above the 50. I think this group looks fine. XLU, again, on a relative basis, not great. Hasn't broken above the June high. But on an absolute basis, I don't think there's anything wrong here with this chart. We are trending back up above the 20 and the 50. Doesn't look too bad. XLRE, this is real estate. Real estate, nice reversal today, by the way. It looked like maybe we were breaking down below these prior lows, below the 50-day. Nice recovery into the close. Finished up more than 1%. I wouldn't be surprised to see real estate make a little bit of a run here. Then that brings us to materials and energy. And there's your breakout on materials. I think the market still looks pretty similar to what it's looked like over the past several months, with one exception, materials. Materials, no doubt, have strengthened. I know that there are a lot of technical analysts that are supporting materials right now. I'm fine with materials. I just don't know that they're going to be leaders going forward. But as the dollar continues to weaken, it certainly looks that way. So we'll be watching the dollar to see if that long-term chart, and that's a weekly chart, So we want to see where we finish on Friday, but certainly the way we started this week is not good for the dollar, which is very good for materials and the relative strength of materials. So right now I'd say materials look good. One thing to keep in mind is just keeping stops tight on this group, because if the dollar does reverse and start to move higher again, you could see materials move back into that weakening area. But right now, all's good. Materials look good right now. XLE, shockingly, with the dollar falling the way it's been falling, really we're not seeing that much strength in energy. And that is a little bit of concern for me. I mean, normally when the dollar's falling, we get outperformance, relative strength from both materials and energy. We're getting it in materials. We're not getting it in energy. Not even close to where we were back in June. I think probably more than anything, it's a supply issue. And that needs to be corrected by OPEC more than anything else. I don't think it has much to do with the dollar at this point. I don't know that it even has much to do with demand. I think demand around the world is picking up. I just think we have an abundance of supply. And so normal economic factors are not really going to play in. The dollar is not really going to play in until we rectify that supply issue. Anyway, that's a look at the various sectors. I do want to pull up gold and just show you gold had a huge, huge day, really the last 6-7 days. I mean, look at this run from 1,800 an ounce to 1931 on today's close. Very, very strong action. If we pull up the 15-year monthly chart, we cleared the highs established in 2011. Now, before you get excited and say, well, you know, gold is just taking off, gold's the best place to be, I think you also have to realize that it's, you know, if we go back and we look on a weekly chart, gold versus the S&P 500, that's critical to me. It's not just what gold is doing, it's whether or not gold is a better investment than stocks, individual stocks. And I'm not so sure. I mean, if we look at this weekly chart, definitely here in 2020, we have begun to advance. And I think if we take out that relative high from March, that could really change the picture, because that would be sending us to about a 6-year relative high. That to me is a different ballgame. Relative highs and absolute highs can be completely different. Now, we have been moving up, but a lot of this is because of all the fear. We've had the trade war, we've had the panic from the pandemic, and that's all feeding into gold. Now we've got the weak dollar feeding into gold. Gold's had a lot of things going for it. The question is, if the market overall continues moving up and the VIX drops, and if the dollar were to reverse, and right now it doesn't look like it's going to, but if it does, and the dollar starts to move higher and the VIX comes down, all of a sudden the two primary factors that are sending gold higher can reverse this. So I think gold's fine. I think trading individual stocks in gold, I think right now is fine. What I'm just saying is be cautious, because we have seen big moves in the past followed by more downside action. This one has probably been as good as any. But again, we've had the trade war, we've had the pandemic, lots of fear, and now a falling dollar. Everything is going gold's way right now. So while in 2011, we were over $1,900 an ounce, and now we're breaking out, it's taken us 9 years to break out above that 1,900 level. We've been going up on the S&P 500 since 2009. So that's why on a relative basis, gold has been the underperformer. Short term, I think you got to like gold, but just again, keep in mind, watch the dollar, watch the VIX. If the dollar starts rising and the VIX goes down, I suspect we will see this failure on a relative basis. So keep an eye on that. All right, let's move on into turning point. And this is just simply looking at stocks that I think are at or approaching a level where we need to be at least somewhat concerned. I'm going to start with Goldman Sachs. If you recall, it wasn't that long ago, less than 2 weeks ago, or maybe right about 2 weeks ago. Remember they came out with the big earnings report? They earned over $6 a share. I think the market was expecting like $3.80 or $3.90. Stock gapped up, opened at $225, $226, whatever. Well, it seems like 6 months ago now. The stock's been going down almost every day. came all the way down to 200, actually just below 200 today, but printed a bullish engulfing candle today. Now, if we go back down below 199, then it negates this reversing candle. But when you get a reversing candle right on your 50-day moving average, that can be pretty impressive and can lead to gains. Take a look back at mid-May. We were downtrending. We put in a bullish piercing candle right at the 50-day. Never went below the low that day. And look at this move over the next few weeks. I'm not saying Goldman Sachs is going to do that, but getting back to where it was when it reported earnings back at 225 doesn't seem like that big a stretch to me. That's 10% higher from where we are right now. And to the downside, you can keep a stop around $4, 22 bucks upside, $4 downside. Reward to risk is solid here. All right, how about RAD? This one has really got my attention because when you gap up with earnings, and I'm going to annotate this chart, when you gap up with earnings and then you take off to the upside, the top of gap support becomes your key area to watch for a possible turning point. Here was the gap up. Look at this heavy volume and the huge hollow candle. We went up, went from we opened at over 14, ran up over 18, and now today, for the first time, tested that top of gap support. We got down as low as 14.16, closed at 15. I think Rite Aid could rally from here. I don't expect it to go down and fill this gap. This is the way I trade gaps. When I get a big hollow candle with heavy volume and we don't go back down initially to fill the gap, I usually look for the top of gap support to hold. So I like this reversal and test. That nice little hammer on Rite Aid looks good to me. All right, more turning point. How about Amgen? Amgen does report tomorrow, or I should say Tuesday. By the time you listen to this, it will be Tuesday. So after the close on Tuesday, Amgen reports. I think it's after the bell. I didn't look to see if it was before or after, but I think they normally report after. But they did pull back, close below the 20-day, and then come right back up with a beautiful bullish engulfing candle on Monday. I wouldn't be surprised to see this make a run for the recent highs as it goes into earnings. AVAV, it's a defense stock. I'm watching this because it did reverse off of that 20-day test. It's got equal highs, rising lows coming in here. Breakout above 80 actually measures up to 92.5. So AVAV could be at a critical point here. Garmin, GRMN, went all the way down, opened at 95. Nice reversal here, though. One of the things I really like about this stock is as it's been going mostly sideways, look at the accumulation distribution taking off. Watch this area at 102.50. I think if Garmin breaks out, it could be in for a run based on the accumulation numbers here. All right, just maybe a couple more. We'll look at a couple of could have topped. We also want to take a look at possible topping candles. And this is one that could be. I mean, we saw one a couple weeks ago, it didn't pan out. That was a dark cloud cover candle on July 13th. That didn't lead to any more selling. We just kept moving higher. Today, we did have increasing volume, pretty significant increase in volume, and a bearish engulfing candle. I'm expecting at least a 20-day test here on TRUP. So I wanted to mention that. KTOS, this is Kratos, another defense company. Look at the false breakout from Friday. See the tops here at 20? Look at that. We got up to a 20 and change, maybe close to 21 intraday. Couldn't close there, though. And then look at how we were down today, 5%. That is one of the signals I look for. If I'm in a stock and let's say I'm fortunate enough to find a bottom and I'm riding it for a week or two and it gets up to resistance and it looks like it's got the breakout and then fails, I think you've got to be ready to just take the profits, move to the sideline, and let the stock set up again. Either you make the breakout, maybe you can rebuy it back a little bit higher, or let it come back down. Maybe you can get in it again at a lower price, maybe that 20-day moving average. All right, let's keep moving on. Earnings spotlight. A few companies I want to mention after the bell tonight reported. NXPI, this is a semiconductor. They missed 70 cents versus 85 cents. You know what? Look at the accumulation distribution. Been going down on a relative basis. Last month and a half or so, it's been rising, but still way down from its 52-week relative high. I think there are a lot of other semiconductors out there that look better than this one. The recent rally that we saw here came on much lighter volume, and I expect the stock to struggle here, to be honest. It is down about 4% after hours. A couple of stocks that came out with really good reports I wanted to mention. Another semiconductor, AMKR. This is Amcor. Not only did they beat on the bottom line by 25 cents, 23 cents in profits versus expected loss of 2 cents. They also guided their Q3 revenues higher, stock up 16.35% after hours, after going up 13% on Monday. So a big move. Looks like we're getting a breakout at the open on Tuesday. Amcor, very, very strong. And I suspect you're going to see this relative strength really shoot higher here. Another stock came out very strong, MEDP. This is MedPace. So this is in the biotech area. I like the biotechs. This is one that has been leading, and it's probably going to be leading even more tomorrow. The stock after hours up more than 13%. They easily beat their earnings, 64 cents versus 42. They guided fiscal year 20 revenues and earnings per share higher. So the stock closed at a high, excuse me, also looks to extend that in after hours. So I think MedPace looks pretty good. F5. Actually, this report was pretty good, but stock was down about 3 or 4% after hours. But we are up here challenging these highs that we saw. This high in particular up near 154. We got to about 156, rolled over. They beat a nice report, F5, 218 versus 205. They beat on their revenues, and then they guided their September quarter earnings per share higher. So it was a trifecta, win-win-win. But the stock had already broken out, or at least on the verge of it, had made a pretty good run into earnings. And so we could be looking at buy on rumor, sell on news. I'd watch that 20-day moving average. I think if it opens back down there, I wouldn't be surprised to see the stock rally back off of that. All right, one last one. I'll pull up SSD. This is Simpson Manufacturing. Stock in a cup, which I think looks really nice. No handle yet, but it is down 2.3% after hours after crushing estimates. $1.22 versus 63 cents. They guided their fiscal year 20 revenues higher, and the stock's down a little bit after hours. I think if this were to pull back over the next few days and get down to that 20-day, this would be a pretty nice cup and handle back to that 20-day moving average. So I definitely keep this one on my list. All right, quickly, let's go through the 3 you must see. I'm going to start with OLED, Universal Display, nice breakout. Look at the volume increasing. Took out that June high. Yes, it's a little stretched now with that 9% gain on Monday, but I expect the stock's going to go higher in time. Next up, CX. This is in the materials area, and CX broke out above this June high. Volume picked up. Relative strength starting to pick up. If it can clear that June relative high, it will be breaking out to about a 5-month relative high. That would be very bullish. And then the last one I wanted to mention on the 3 you must see is Deere Company. Deere, I think, looks really strong. We've got overhead resistance. Watch this 175 to 180 area. If you see Deere above 180 and the volume picking up, I think it's institutional accumulation. That is it for today. I wish everybody good luck on Tuesday. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.